The company is a global leader in something called subsea Ashtead Technology.
A bit of a British success story.
Survey and robotic, mechanical solutions, asset integrity.
Very strong competitive advantage, control 50% of the market share.
Financially performing extremely well. In the last 5 years, it's returned roughly 175%.
There's not many of them around nowadays in the UK stock market.
Now, you might be listening thinking, why on earth are we recommending a company whose shares have fallen 45%? But I'm firmly of the view that it's got great prospects to grow. Welcome to the latest episode of the Intelligent Wealth Podcast. And as usual, I've got my two eminent guests, Carl Roberts, Fellow Director of Minerva Money Management, and Awet Gourmet, who is our Head of Research. So, this podcast is all about investments in shares, public companies, what we specialize in. It's about giving you a lot more information and research into shares that we may or may not own in the fund already. But it's the idea is for it to be an aid to you, to help you in your own research, because we strongly feel you should do your own research. Just don't rely on advice from us, because our comments are purely our opinions. You have to make your own mind up. We can't treat this as advice. Of course, investments will rise and fall in value. You may not get back the full amount you've invested. That goes without saying. But this is for experienced investors, value investors, we'd say. Not value investors, quality investors is what I meant to say. People who believe in this quality investing approach, which has one of the most successful track records of all. So, without any further ado, let's proceed on to the subject of today, which is a company that we are invested in the Intelligent Wealth Fund ourselves, and the company is called Ashtead Technology. Now, this is not one of those very well-known companies, and that's one of the reasons we really like it. It is publicly quoted. They had an IPO back in 2021. The company is a global leader in something called subsea equipment rental and support services for offshore energy. So it operates through three key segments, the first of which is survey and robotics. Second one is mechanical solutions. The third one is asset integrity. We'll explain what this all means as we progress, but basically they get involved in every stage, which makes them quite an interesting company. So they get involved in installation of equipment, inspection, maintenance and repair, and even decommissioning, although the decommissioning tends to be more towards traditional energies like oil and gas. So they're more pro-renewable and decommissioning oil and gas, really, which is the whole global trend. So they're involved in both sectors, renewables and fossil fuels. In terms of the background of the management, we always find this useful. We always like it when the CEO has skin in the game, we call it. They own shares in the company, because that they tend to run businesses better when they've got their long-term investors like that. So luckily we do have the case here. The CEO is Alan Pirrie. He's been the CEO since 2012. He only owns just under 2% of the shares of the company. That's a bit on the low side. We prefer 10%, but it's still a good sign, because what we find is that shareholder owners, he's not the founder of the company, I don't believe. The company's been around since 1985 and had different corporate owners. So it doesn't fit the model exactly how we like it. We like them to be founder owners that are visionary. He's not quite there, but it doesn't have to be. I think he's got enough incentive with just 2% of the company to do the right thing. And what we find is that these owners, these CEOs who own shares in the company, tend to do the right thing more than CEOs who don't own shares, if only because they've got aligned interests with the shareholders. And we think that's a really important criterion for investing in companies. We want them to do the right thing. So the total insider ownership is just over 2%. So there's not much else that the other executives own in terms of shares in the company. A bit on the low side, but it's better than zero, put it that way. And it's financially performing extremely well, as Awet no doubt will explain when we come to his section of this discussion. For example, earnings per share 50%, return on invested capital 25%, total shareholder return 25%. These are sparkling figures, and they're the kind of metrics we like to see and read about. Now, it's only been public since 2021, so that's a short period of 4 years, but there's been no dilution of shares in that period of time. We quite like that. Now, in the last 5 years, which goes slightly beyond the time since the IPO, it's returned roughly 175%, which I think is a stunning return when you consider that this year alone it's fallen 45%. Now, you might be listening thinking, why on earth are we recommending a company whose shares have fallen 45%? But I'm firmly of the view that a big fall in share prices, as long as your research stands up and you still believe in the company and you still think it's got great prospects to grow, is a brilliant sign that it's a Black Friday event. Now's the time to invest. Now, remember, as I said at the start, this is purely my opinion, but it's just a general opinion that if you still believe in that company, best to invest when you've had a good share price fall. Now, and that sounds perverse to say a good share price fall, but remember, Amazon, that's been around a little over 25 years, has had 4 occasions when their share price has fallen 50%. Now, show me a fund manager who's remained invested in Amazon over that long period of time. You won't find one. But the share price has gone up over 3,000% during that time. So the key is when prices fall, as long as your research doesn't show up anything that's bad about the company, now's the time to invest, in my opinion. But of course, do your own research and come to your own conclusions. You might think differently after this podcast. That's enough of me for now. I want to pass you over to Carl, who's done quite a lot of research on this company. He's got some very interesting information to tell us. I hope I haven't stolen your thunder, Carl, with those performance figures, but over to you now.
Yeah, what we're going to talk about now, you just said about the performance. Ashtead is one of these, I'd say, well, first of all, Ashtead Technology, not to be confused with the Ashtead Group, which is a separate company, separately listed company, which rents out construction vehicles. So that sometimes when you're searching Ashtead, you can get confused with the group there. So we're talking about Ashtead Technology today. And essentially, I think it's a bit of a British success story, which there's not many of them around nowadays, is there, in the UK stock market? So it's quite good to celebrate a company like this. AIM listed stock, so it's on the AIM market, but I do believe they are trying to transition to the main market. So that's also a good sign. For those people that are not familiar with the AIM market, that is generally the kind of smaller market on the London Stock Exchange where the rules are not so compliance. There's not so much compliance to get listed onto that market. So they tend to be smaller companies or upcoming companies. But sometimes larger companies stay on there for a long time just because the rules aren't so onerous like they are in the main market. But yeah, as I understand it, Ashtead Technology are trying to transition to the main market. Yeah, obviously, Tony, you've gone through the performance figures. We can come back on the valuation a bit later to see whether that makes sense to buy them now. But I think where their kind of competitive advantages and what's interesting about the company is that essentially it's got, I think, around over 30,000 assets, they call them, basically equipment that they could use underwater and rent out to other companies that need this type of equipment, because this type of equipment obviously is highly specialized. You need a lot of knowledge to be able to operate this kind of almost like robotic robots, deep underwater, looking at oil pipelines, wind farms, where a lot of this equipment is drilled way down underwater. So you really need a specific set of tools and knowledge to be able to work on these kind of areas. And where Ashtead are really good is that they've got all the equipment. And so other companies that come along, engineering companies that have to do a job underwater, it's very expensive for them to go out and purchase the kit they need to do that job as a one-off, say, or every now and then. It's much easier for them to rent the equipment from a company like Ashtead and use it every now and then, because then they're not spending so much capital expenditure on their balance sheet. You made a good point off air, Tony, with when you need some work done in your house and you need scaffolding, you don't go and buy your own scaffolding and put it up on your house and then keep it forever and store it, because you might only need it once. Instead, you're going to rent out that scaffolding and get the job done. So this is essentially where Ashtead come in. So I think that's quite a good sort of niche area and a good bit of a competitive advantage. And they've obviously over time built up a huge amount of assets now and also the knowledge, because not only will they rent you the equipment, they provide the team to set it all up and teach the engineers how to use it, so then they can go and do it themselves, which is also good because then they're not responsible for the job. Essentially, they're just providing the equipment to the company that's been commissioned to do the job. But then obviously once they pass that over, it's the company that's rented out the equipment's responsibility to do that properly. So all they're doing is providing the equipment. So again, I think that's quite a sort of a niche area. They kind of straddle two markets, which is really interesting, or two sectors. So they're very big, also I suppose the large majority of their revenue comes from oil, that type of energy. So they're sort of helping in decommissioning oil rigs, things like that. And then the upcoming sector they're working in is kind of offshore, so offshore wind farms. So they're kind of got a piece in both pies essentially, which is quite good from a diversification point of view. So yeah, interesting company. Dev, Albert wants to chip in on some of these areas.
Yeah, when we look at Ashtead Technology, they are oligopolistic market. I mean, they control 50% of the survey and robotics market, which is quite strong market share they have. And this company, they have been around for 40 years, as you mentioned, Carl, as well. They have 30,000 rentable asset, which is they provide one-stop shop for everything that you need, which is, I think, is very critical. When we look at the offshore energy market, is what you realize is the market is not driven by price, it's driven by efficiency and reliability, and Ashtead provide that. And what we've seen is after the Russian war, we've seen there's a emerging trend for energy independence. And I think that the require for most countries to be energy independent is rising. And that's actually by government support and so on. And we see that's actually one of the biggest market moving forward for Ashtead. And when we go for Ashtead, they have a very strong competitive advantage, as we mentioned earlier, like 50% of the market share. And they have a scale advantage. When you are Ashtead, what you could do is you can buy things on bulk and you get a discount, a bigger discount, so that you pass on to consumers. So consumers can stay with you and you have high utilization for equipments. And they have a strong global footprint. For example, they have a presence in around 80 countries. And I think if you speak to customers of Ashtead customers, they all are very happy with Ashtead, what they provide. And that seems to me, based on the research that I have done, they have a high switching cost. And they have a really strong data advantage in comparison to other companies. And Ashtead, in their annual report as well, they confirm that they have data advantage. What they will do, the data is, for example, they'll be able to see where the equipment is required and they will maneuver it with the speed. And that's very, very important for a rental business, because when you rent your equipment, what you need to make sure is you need to use it efficiently, and you have to make money, because they are, at the end of the day, they want to make money and profit for investors and shareholders. So that's actually very strong for the company. And in terms of profitability, the company is quite profitable in terms of like gross margin 77%, sorry, and operating margin 26.3%, and net margin 17.1%. So it's still profitable, and the company is deploying the capital by acquiring more businesses and growing. So they are growing, and I think what we see is in research, there are a lot of business for sale, because a lot of business owners are retiring and they're approaching the retirement age, and Ashtead are able to buy those businesses and build them and improve their rental and assets and so on. So we can see there's a growth market. As we mentioned, the company has been growing since IPO around 30%. So that's going to continue. The organic growth is a lot less, but the acquisition, if you add it together, it's around 30%. The organic growth is around 16%. So the company is growing. And even when we look at the in general, the offshore energy market is expected to grow by 21%, and especially in Europe is expected to grow by 43.2% through 2030.
Howard, sorry to interrupt. With all these figures, we're talking about per annum, aren't we? We're not talking about cumulative. You didn't make that point. I just think important for the listeners.
Yeah, it's per annum.
Yeah. Okay.
Yeah, per annum. So it's the market is growing, as we mentioned, and the business is positioned to win from this structural change, which is energy independence. And I forgot to mention earlier on as well, AI is going to consume a lot of significant energy, and the energy need to be used now. And I think a lot of companies will be going to discover more energy, and we can see the business will benefit from this structural change of energy needed in the future.
Right. Okay. Anything more to add, Howard? I can see you've made some notes about stock-based compensation, for example, and shareholders' yield.
Yeah, the company, the way they incentivize management is by 50% earning per share and 25% return on capital and 25% total shareholders return. So the way they are incentivize management is by providing more value to shareholders. And I think the dilution for shareholders has been quite fairly around 3 to 4% so far, and that's pretty much not a lot in comparison to other companies which they issue equities and dilute shareholders. And so so far they have done really well. And when we look at the capital allocation is being through cash generated from the business and a little bit of debt as well. So that has been one of the way of doing and growing the business.
And now, what do you consider to be the risks of investing in Ashtead? Because there definitely are some risks.
Yeah, I mean, the risk is pretty much there's a lot of the energy business is a cyclical business, right? And will depend if there's if there's more cyclicality, the equipment rental business demand will be lower, and concentration of customers is one of the risks that we see. And I think what we've seen, especially like you mentioned earlier, Tony, about the share price is down 45%, and the reason is pretty much when Trump was coming to power, the market was panicked because they could see Trump was against the renewable energy, and I think that the market was overreacted because Ashted didn't have a lot of exposure to the US. As I mentioned earlier as well, most of their equipment can be maneuvered around and it can be redeployed anywhere in the world. And at Ashtead, they have the technology and the data to do that. So I think that we've seen the earning recently, and still the company is growing, and the forecast is still good. That's why the share price has recovered from the panic. So the biggest risk is, as I mentioned, is execution risk when you growing through acquisition, and the management have to execute what they have planned. And I think that's one of the risks. And I as you mentioned earlier as well, it's not run by a visionary founder owner. It's still run by a CEO. So that's one of the risks, that you don't have some sort of like Elon Musk style risk taking. You have a business with a CEO which is aligned with shareholders, but not like a visionary and like an Elon Musk type of CEO. So that's one of the risks that we see. And I think the biggest risk as well, like if you look at the balance sheet, you can see goodwill makes around 36% of the total asset, which is a significant higher than what we require for a company, because we need to see a quality balance sheet. In that case, this is one risk that we see. But you have to consider this is a company is growing through organic and acquisition. So it's quite common to see higher goodwill because you are acquiring business along the way.
Yeah, it certainly seems to be a company that is able to acquire businesses, and and absorb them and manage them into the business. Because there's not many companies in the world that are able to successfully acquire companies consistently. I mean, we've covered some in this show, like Constellation Software.
Yeah.
That seems quite rare, but they seem to be achieving that. It seems that the company is very well run. What I was particularly impressed by, not just the figures, the margins that are pretty high, but the fact that they deliver the equipment so quickly. They've got a very, very good reputation, and of course that's critical with any rental equipment, as you'd know from your own home. If you're hiring scaffolding or a skip or whatever, you want speed, don't you?
Of course.
Speed and efficiency. So they definitely seem to do that. What's interesting is he seems to have, because they've got fingers in both pies, if you like, the renewable energy sector and the traditional fossil fuels energy sector. I think that sets them up well, because although they're focusing more on decommissioning oil and gas, I presume they'd be able to do the opposite. If it became back into favour, and there are early signs that that's happening, then they could easily make that shift, couldn't they? And you could imagine if it does go back to oil and gas, that there'd be commissioning oil and gas plants and decommissioning wind turbines. So it does set them up quite nicely with being in both camps, I feel. And I think that's a big advantage to a company of this nature. You know, the figures are stunning, really. The overall returns are pretty amazing. And I like the fact that it's off the radar. Not many people have heard of Ashtead Technology, and it's a very niche product that they offer. And as Carl says, it's one of the few British success stories. And of course, as we know, when leading up to going onto the main market from AIM, usually that has a good effect on share prices, assuming it's a good company, of course, in the outset. Usually that jump from AIM to the main market, like the jump from, say, the FTSE All-Share Index to the FTSE 100, usually that recategorizing usually has a good effect on the share price. A bit like getting promoted from the Championship in football to the Premier League. You know, it makes a huge difference. And I feel that we're in that kind of situation here, although obviously we can't forecast what will happen to share prices in the short term. None of us knows. But it does look very promising, I think, overall.
Yeah, I think when we look at the company as well, the economic unit, like when they buy the equipment, the useful life for the equipment is more than 10 years, and the company makes their money back within less than 2 years. So the rest of is
really
pretty
good.
much profit. So this is pretty much very good for the company, and I think there is like a trend as well by the offshore wind to rent instead of buying, because there's a lot of benefit. You know, there's a lower cost, upfront cost, and there's an accounting treatment as well. When you buy the equipment, you don't have to, I mean, you have to depreciate it over time, and there's a lot of cost comes on the profit. So if you don't want a pressure on your balance sheet, you could just rent it one off, and the cost is minimum, and the company will look profitable. As a business, that's the best way to approach it, especially if, as you mentioned, if the equipment is not consistently needed, it's one off or so on. So it's the best way to rent rather than buy.
I'm going to ask Carl something here. Carl, have you ever hired a skip?
No, I don't think I have.
I thought I'd ask something you could answer, but never mind. Anyway, well, can you imagine the cost of a skip? I mean, you must have some idea of what a skip would cost. But I in my simple mind, I look at the cost of a skip and think they must be making their money many times over. It can't cost that much to buy a skip compared to the amount you can get for renting it out. It must pay itself back so many times over, don't you think, Carl?
Yeah, it's the practicality, though, isn't it? To the end user, it's the practicality. You know, there's so many jobs that you need specific tools for, and it's just not practical to buy all your own stuff, is it? You know, unless you're in that market. And I think where they're clever, and the key point to keep remembering is that they don't do the jobs. They are an equipment provider today and a knowledge service sort of provider. So, you know, it's they're not competing with these deep sea companies that actually have been commissioned to do the job. They're providing these companies with the equipment. So I think that's quite clever. So their actual competitors, there's not that many around, because you could say, oh, they're competing with the actual people that have been commissioned to do deep sea work. But even these companies won't have all their equipment. They'll still be missing the odd tool or the odd, you know, robot or camera they need, or even just a certain skill set. And that's where Ashtead come in, because they've got it and they can give that to them quickly. So from a competitive point of view, they're quite clever, and they have been buying up some of people you could be classed as competitors or expand in their kind of knowledge area. So that's really interesting. I think just going back to your point, Tony, on the move into the main market. I mean, one of the reasons why that does usually cause a spike in increase in share prices, of course, is it's going to then bring them into new markets in terms of all these tracker funds that will track, the FTSE. So straight away, all these pension funds might need to go out and buy that stock if it's now in that market. So again, going back to the valuation, why it could be quite a good time to buy. I think then there's still lots of kind of evidence out there that the areas they're in, there's now conversations around whether we stick with going down the kind of renewable route, but it's still predicted, offshore wind's predicted to grow, I think 21% a year. Europe's offshore, I think Europe is still massively kind of into renewables, whether we like it or not, and that market alone is predicted to grow 43% a year. I think the markets they're in is only kind of set to grow. I think it's a kind of potential hidden gem.
Because the regulations help you as well. I always feel if you're on the right side of regulations, if you're providing a service which is demanded of the regulators, that usually is quite powerful headwind, isn't it? That helps.
It can be bad for economies, countries as a whole. It's not the way some of these regulations are. But the people that do make a big success of it are the companies that can kind of link off the back of it, aren't they? Just look at HS2 and the reasons why that's so expensive. It's mainly because there's so many companies that can get a load of money out of the government, isn't there? So
it's always good to have that tailwind behind you, I think, in terms of the company's prospects for the future. I think that's really good.
Yeah.
I think we've probably covered as much as I can think of for this company, Ashtead Technology, unless you got anything else to add, you two guys, because I do sometimes get told off after the show that I've cut them short. So now's your chance.
Yeah, I mean, if you think about it, energy is a critical need for everyone. I think if you think about the whole thing, what we do is like it requires energy. Our food processing require energy. The podcast that we do require energy. So energy is embedded in everything in our life, and it's the requirement. The need for energy is growing either way. We renewable, nuclear, or the traditional energy is going to be in demand in the future. So I think the company either way will benefit from this structural growth in the future.
I think you're absolutely spot on. Anything else? Any last few comments, Carl, from you?
Yeah, and added to that, it's a key kind of tool maker, isn't it? It's not the it's not the gold itself. It's the tool makers. This is what they are. So yes, you're absolutely spot on, Eric. We need lots more energy, but rather than going direct to invest in the energy companies themselves, you want to invest in all the tool makers that are going to make profits off the back of that transition. So
and of course, the other big advantage is it's a boring company. I quite like boring companies because they're off the radar. They therefore their share price doesn't tend to get ramped up too much because they're not so highly known. So I quite like that aspect of it. It's quite unusual, quite a good niche they're in. Anyway, thanks for all your comments, gentlemen. It was a fascinating discussion as usual. We will put links in the show notes. We do also have a one-page company snapshot on Ashtead Technology. If you'd like to avail yourself of that, contact us. Look at the show notes, the links below, and we'll happily provide that to you to help you in your own research to make your own decision whether you should buy it or not. We'd like to ask you, if you're watching this on Apple Podcast, please leave us a review, because that helps push us up the rankings and will attract more listeners, which we'd be really grateful for. But we really appreciate your time attending our show today. And we look forward to meeting you all again on the next one. So thanks very much, Carl and Albert, for your time today, and have a great day, everybody. Bye for now.
Thank you for joining us today. Please help us spread the word by sharing this podcast with your family and friends. And don't forget to subscribe.